Gold crashed 12% this month. Silver is down 37% from its all-time high during a war, during the biggest geopolitical crisis in a decade. The one thing that is supposed to go up when the world falls apart just crashed. Now I know what the mainstream financial channels are telling you. They are telling you the bull market is over, that metals had their run, and that it is time to move on. But here is the problem with that narrative. While gold was crashing on the COMEX, somebody in Dubai was paying $91 an ounce for physical silver. That is 24% more than the screen price. If the metals bull market were really over, nobody would pay a premium like that. Not even close. If you hold gold or silver and you have been watching the price collapse, wondering what is happening, the next 15 minutes are going to show you exactly who is behind this crash, why the reversal is going to be fast, and the one data point from Shanghai that changes everything. Let me set the stage for what actually happened, because the timeline matters more than most people realize. Gold hit an all-time high above $5,500 earlier this year. Silver touched $116. These were historic levels. Silver had not been that high since the Hunt brothers squeeze in 1980, and then in the span of just a few weeks, both metals were crushed. Gold fell to around $4,632 on the COMEX close Friday. Silver collapsed to $73.49. The financial media celebrated. Bloomberg ran the headline, "Precious Metals Bubble Bursts." CNBC brought on 3 analysts in one day to explain why metals were finished. Every headline screamed that the bull market was over, but here is what none of those headlines mentioned. The crash happened almost entirely during Western trading hours. Between 6 a.m. and 2 p.m. Eastern, when the COMEX futures market is most active, paper contracts worth billions of dollars were dumped onto the market, not gradually, not over weeks, in concentrated bursts during the most liquid hours of the New York session. But when the Shanghai Gold Exchange opened that same evening, something completely different happened. Physical buying surged. The Shanghai premium over London expanded to between 5 and 13%. Let me say that again so it sinks in. The same metal that Western futures traders were selling was being bought at a premium in Asia. That is not a market crash. That is a market divergence. And if you understand the difference between those two things, you understand why this reversal is going to catch most people completely off guard. Subscribe right now, because what I am about to show you is not on any mainstream financial channel, and this data changes the entire picture. Let me walk you through the 5 layers of evidence that prove this crash was engineered, and the reversal is already underway in the physical market. Layer 1. The price action itself. Gold dropped from around $5,500 to $4,632. That is a 12% decline in a single month. Silver fell from $116 to $73.49. That is a 37% crash from the all-time high. Now think about what was happening in the world during this exact period. Iran and Israel were locked in the most dangerous military escalation in decades. The United States was deploying carrier groups to the eastern Mediterranean. Oil prices were spiking above $100 a barrel. Treasury yields were whipping around as bond markets priced in escalation risk. Global uncertainty was at levels not seen since the start of the Ukraine war in 2022. Every single historical precedent says gold and silver should have been screaming higher during this kind of environment. Instead, they crashed. That is not a market responding to fundamentals. That is a setup. And if this data surprised you, hit the like button right now, because most people have absolutely no idea this is happening, and this video needs to reach them. Layer 2. Who caused this? In the week of the sharpest decline, COMEX open interest surged by over $6 billion in notional value. That means billions of dollars worth of new paper short positions were opened, and that selling was concentrated in the first 2 hours of the New York trading session. This is the same pattern we have seen in every major precious metals takedown since 2011. Large institutional short positions deployed at the exact moment of maximum geopolitical fear, when retail investors are most likely to panic sell alongside the wave. JP Morgan, and the big four bullion banks held record concentrated short positions according to the latest commitment of traders data from the CFTC. Bank of America's Metals Research Desk noted the concentrated selling was unusual, even by historical standards. This is not speculation. This is not a conspiracy theory. This is the CFTC's own reporting available for anyone to read. The question is not whether the selling was concentrated and institutional. The data proves it was. The question is why they did it during a war when metals should have been their most bullish. Now here is where it gets really interesting. Layer 3. What the East is doing while the West is selling. At 6 p.m. Eastern last night, Wall Street closed for the weekend, but Shanghai was just getting started, and in the first hour of Asian trading, gold was bid 5 to 13%. Chinese importers were paying the equivalent of nearly $4,900 per ounce, while the COMEX paper price sat at $4,632. That is not a small discrepancy. That is a structural premium that has persisted for months and is actually widening. It reflects the fact that Chinese central bank demand, household gold accumulation, and industrial buying are all running at levels that the Western paper market simply cannot suppress forever. The People's Bank of China added over 230 tons of gold to official reserves in the last 12 months, according to the World Gold Council. But analysts at SP Angel and Goldman Sachs estimate that unofficial purchases through state-affiliated banks and sovereign wealth funds could be 3 to 5 times that reported figure. India is paying elevated import premiums driven by both new tariffs and surging wedding season demand. Central banks globally added over 1,100 tons of gold in 25, the third consecutive year above 1,000 tons. Think about what that means for a moment. One side of the world is playing a video game with paper contracts. The other side is taking home the physical prize. And when the game ends, only one side actually holds anything. And it is not just gold. Layer 4. Silver tells an even more dramatic story. And this is the part that should really concern you if you are paying attention. In Dubai right now, physical silver is trading at approximately $91 per ounce. The COMEX spot price says $73.49. That is a 24% premium for physical metal over the paper price. Walk into any dealer in the Dubai Gold Souk and try to buy a 100-ounce bar at the COMEX screen price. You cannot do it. The Perth Mint reported elevated demand for silver products throughout March. The US Mint has been rationing American Silver Eagle allocations to authorize purchases. Premiums at major online dealers like APAMEX and SD Bullion remain elevated above historical norms. The paper price says one thing. The physical market says something completely different. The paper price is fiction. The physical price is reality. Now let me show you the math that ties this together. The gold to silver ratio currently sits at roughly 63 to 1. That means it takes 63 ounces of silver to buy 1 ounce of gold. The historical average going back centuries is around 50 to 1. At the 1880 and 1980 peaks, it hit 15 to 1 and 16 to 1 respectively. If gold stays at $4,632 and the ratio simply reverts to 40 to 1, silver goes to $115. At 30 to 1, silver reaches $154. At the historical 15 to 1 ratio, silver hits $308 per ounce. This is not speculation. This is not hope. This is mathematics. Do you think silver hits $150 before the end of 2026? Comment yes or no below. No hedging. Own your call. I want both sides represented in these comments because I am going to come back to this in 60 days and we will see who was right. Layer 5. Why the reversal will be fast and why timing matters right now. Every major precious metals crash in the last 25 years has been followed by a reversal that was faster and more violent than the decline itself. In 2008, silver crashed from $21 to $8 in 4 months during the financial crisis. It then rallied to $49 in the next 30 months. That is a 500% gain from the panic low. In 2020, gold dropped from $2,070 to $1,680 in a single week during the COVID liquidity crisis. It recovered to $20.75 within 5 months and went on to make new all-time highs. The pattern is consistent and it is repeating right now. Paper selling drives the price below fair value. Miners cut exploration and development spending. Physical demand accelerates because stackers recognize the discount. The supply squeeze builds invisibly in the background while the financial media declares the bull market dead. And then when the paper shorts finally have to cover their positions, there is nothing available to buy at the prices they sold at. The all-in sustaining cost for primary silver production sits around $22 per ounce globally, according to the Silver Institute. At $73, miners are still profitable, so production has not yet been cut, but the rate of new mine development has collapsed. It takes 7 to 10 years to bring a new silver mine from discovery to production. Meanwhile, industrial demand from solar panel manufacturing alone consumed over 200 million ounces last year. AI data center construction and EV battery production are adding another massive wave of structural demand that simply did not exist 3 years ago. The Silver Institute confirms the market has been in a structural supply deficit for 4 consecutive years running. More silver is being consumed each year than is being mined. And the above-ground stockpiles that used to buffer that deficit are draining fast. COMEX registered inventory has declined steadily over the past 18 months with no sign of reversal. Now let me make this personal because data without context is just noise. If you are stacking 100 ounces of silver at today's COMEX spot price, that position is worth $7,349. If the Dubai premium gap closes to the upside and silver reaches the $91 physical price, that same stack is worth $9,100. That is a 24% gain just from the paper price catching up to where physical metal already trades. If the gold to silver ratio reverts to 40-1 with gold holding at $4,632, your 100 ounces are worth $11,500. And if the ratio reaches the historical 30-1, you are looking at over $15,400 on the same 100 ounces you hold today. The signal to watch over the next 2 weeks is the COMEX registered vault report and whether the Shanghai premium compresses or expands. If the premium widens further, the physical market is telling you loud and clear that the reversal is accelerating regardless of what the paper price screen says. If COMEX registered silver drops below current levels while Asian premiums hold, that is the confirmation signal. There are 3 types of people watching this video right now. The first type is scared. They see gold down 12% and silver down 37% from the high, and they are questioning everything they believed about precious metals. The second type is confused. They know something does not add up. They know metals should not crash during a war, but they cannot explain the disconnect and the mainstream media is not helping. The third type understands exactly what is happening. They see the Dubai premiums, they see the Shanghai premiums, they see the COMEX data and the CFTC reports, and they know that what the paper price says and what the physical market is doing are 2 completely different stories. Which type are you? If you are stacking physical metal at these prices, you understand something that most of the market does not. The institutions that engineered this crash are the same institutions that will be forced to cover when the physical squeeze accelerates. Markets transfer wealth from the impatient to the patient. That has always been true, and it is especially true in precious metals. Based on the historical pattern, my analysis suggests the reversal window is measured in weeks, not months. Every individual must assess their own circumstances, risk tolerance, and investment objectives. This is not financial advice, but the data is right here, and I have showed you every piece of it. Every reference is in the description below. Share this video with someone who is confused about what just happened to gold and silver, because the explanation matters more than the price action. If you want these alerts before the mainstream catches on, subscribe and hit the bell so you never miss a signal. I will see you in the next one.